Hello, this is Jake Sanders for Wealthy and P's Market Minute. No doubt, lately you've probably heard a lot of conversation about the debt ceiling, and in particular, whether or not Congress and the White House can get their act together and figure out a compromise in order to stave off potential default in certain government obligations. Now, if this sounds familiar, it is. In fact, since 1960, according to the Treasury's own website, Congress has had to address this very issue 78 times. If you're doing the math, that's more than once a year. So this is not new territory. I would start by saying that even today, the probability of this happening, default, is still very low. In fact, depending on who you pay attention to, most odds makers are putting it between 3 and 10%. So that's pretty low odds considering. Now, that being said, even if the debt ceiling is not raised, there is still enough government revenue to fund a lot of obligations, including bond payments. And in spite of what you've been hearing on the news about entitlement cuts and things like that, I think the reality is that government will just have to be more responsible and take care of the priorities in terms of the debt and the budget. So what about the stock market? What will happen there? Well, if the last 78 times are a guide, and I think they should be, we can expect more short-term volatility in the intermediary. However, over the long run, in spite of the investor uncertainty and probably a lot of anxiety around this issue has not caused long-term impact on the markets as a whole in and of itself. If you have questions about how we're dealing with that or how we're preparing for that, or want to find out anything more or more about this issue, you can find us at wealthep.com. Thanks. Hope you have a great day.